You have spent months, perhaps even years, chasing every single trading strategy available on the internet. You have mastered support and resistance. You have memorized every single candlestick pattern in existence, and your screen is constantly filled with indicators like RSI, MACD, and moving averages. But despite all of this, despite your hard work, your sacrifices, and those sleepless nights, your account balance is still stuck in the same place, or even worse, it is slowly getting wiped out. Every time you find a clean setup and enter the market with full confidence, it feels like some invisible hand suddenly pushes the market in the exact opposite direction. You hit your stop loss right at the bottom, and then painfully watch as price reverses from there and moves like a rocket toward your target without you. You completely give up, lean back in your chair, tears of frustration and anger in your eyes, and keep asking yourself the same painful question again and again. You are going wrong? Why does the market always seem to wait for my entry before reversing? What is that missing hidden piece that I cannot see? The one that only the top 1% institutional traders have kept to themselves. Today, I am not here to sell you a generic retail presentation or some useless indicator. I am here to talk to you as a brother and a true friend who has gone through this exact pain, so I can reveal the most hidden and classified secret of the trading floor. Today, we are going to break down the exact execution model used by big banks to make millions of dollars, the entry model that almost nobody talks about in the entire world. This video will completely shake your understanding of technical analysis, so clear your desk, put your phone aside, and give me your full attention. Because once you start seeing the market from this perspective, your entire way of reading price action will change forever, and you will never look at charts the same way again. To truly understand this secret entry strategy, we must first face a very big and organized lie that has been sold to retail traders for decades. If you look at any common guru on the internet, any financial website, or any trading book, they will all teach you the same recycled formula. When resistance breaks, buy. When support breaks, sell. They tell you to wait for breakouts, watch for retests, and jump into the market with the crowd. But let me ask you a very honest and logical question. If these textbook patterns really worked so well, then why do more than 90% of traders lose their hard-earned money and life savings? The bitter truth is that these retail patterns are deliberately taught to the masses so that they can create the liquidity that institutions need to fill their massive orders. Big global banks, hedge funds, and central market makers do not look at the market through beautiful chart patterns or colorful indicators. They analyze the market purely through human emotions, engineered panic, and hidden stop-loss liquidity. They know exactly where retail traders place their orders, and they hunt those zones before initiating the real move. The secret entry we are talking about today does not follow retail logic. Instead, it completely flips it upside down. We do not buy breakouts. We patiently wait for the breakout to fail so that the crowd gets trapped, and then we enter alongside institutions at the exact moment of maximum pain. Now let's go deeper into how this institutional setup actually works. The entire process begins in a quiet phase of the market known as a range or consolidation zone. In this phase, price moves between a defined support and resistance. For a retail trader, this looks boring and meaningless. But for institutional algorithms, this is a carefully designed accumulation phase. As price moves up and down, thousands of retail traders start placing buy orders at the bottom of the range and sell orders at the top. Naturally, their stop losses are placed UST below support for buyers and just above resistance for sellers. In financial markets, a stop loss is not just a line on your screen, it is a real live order. A buyer's stop loss becomes a sell order, and a seller's stop loss becomes a buy order. This creates massive liquidity pools around support and resistance. Banks cannot execute large positions in quiet markets because there are not enough opposing orders. If a bank wants to buy a huge quantity, it needs an equal amount of sell orders. That is why they must reach into those stop-loss pools and trigger them in a planned move. This brings us to the next phase, building the trap. Once institutions identify that a large pool of stop-losses is sitting below support, they intentionally push price downward with aggressive momentum breaking the level. To the retail eye, this looks like a bearish breakout, and traders start selling aggressively. At the same time, stop losses of buyers are triggered, creating a wave of forced selling. With the market is flooded with panic sellers and breakout shorts. This is exactly the environment banks were waiting for. They absorb all that liquidity and fill their buy orders. Once their orders are filled, downward momentum disappears instantly, and price snaps back upward, completely reversing the move and closing back inside the original range. This is called a liquidity sweep, and it often leaves a long wick on the chart. Breakout traders are now trapped in losses, and early buyers have already been flushed out. Now let's talk about the exact entry mechanics that almost nobody explains, the execution protocol that allows you to take advantage of this institutional manipulation without guessing or fear. Most traders who understand fakeouts try to catch the falling knife. The moment they see price-breaking support, they instantly buy, hoping it is a fakeout. This is not professional trading, this is gambling, because there is no structural confirmation that institutions have stopped pushing price lower. Elite entry strategy requires patience and structural confirmation. After the liquidity sweep, you must wait for a clear shift in market structure. We need a strong bullish candle from the swept liquidity zone that aggressively breaks the previous minor swing high. This is the confirmation that institutions have finished filling their buy orders and are now pushing price upward. Once this momentum candle closes strongly, the setup is ready for execution. We do not enter at the top of that green candle. Instead, we look for institutional footprints left behind, an order block and a fair value gap. The order block is the last bearish candle before the explosive move. The fair value gap is the imbalance created between the first and third candles of the impulse. Price naturally tends to return to these imbalances to rebalance liquidity. Your entry is placed at the order block or at the midpoint of the fair value gap using a limit order. No panic, no chasing price. You simply let the market come to you. Your stop loss is placed just below the liquidity sweep wick, and your take profit is set at major liquidity pools above. This creates a high risk to reward setup, often 1.3, 1.5, or even 1.10. But understand this deeply. Learning this strategy is only half the battle. Even the best strategy will fail if your psychological state is broken. Trading is not about predicting the future, it is about managing risk and executing consistently. Most retail traders fail because they cannot accept losses. They take losses personally, start revenge trading, increase lot sizes, break their rules, and eventually blow their accounts. Professional traders treat losses as business expenses. They know no strategy has a 100% win rate. They protect capital and wait patiently for the next setup. You must change your relationship with losses. Even with a 40 to 50% win rate, if your risk to reward is 1.3, you are mathematically profitable. For example, if you take 10 trades and lose 6 of them, losing $10 each time, you lose $60. But if you win 4 trades and make $30 each, you gain $120. You still end up in profit, despite losing more trades than you win. This is the real secret of the top 1%. They do not care about being right all the time. They care about making more when they are right and losing less when they are wrong. To trade like institutions, you must also understand time frame alignment. Markets are fractal. The same liquidity sweeps, order blocks, and structures appear on all time frames. But retail traders make the mistake of trading lower time frames without understanding the higher time frame context. Professional traders start from higher time frames like daily, 4-hour, and 1-hour charts. They identify major liquidity zones and trends first, then refine entries on lower time frames. This protects them from noise and fake moves. You must also respect session timings. Markets do not move randomly 24/7. Major moves are created during London and New York sessions when institutional volume enters the market. London and New York openings bring billions of dollars of liquidity. Without volume, there is no real move, only noise. A professional trader is like a sniper. They do not trade all day. They wait for London or New York open, execute with precision, and walk away. Let's be honest. If you want to escape retail losses and move toward consistency, you must give up the addiction to instant profit. The market punishes impatience. If you enter charts thinking you must make money today, you are already defeated. Your job is not to make money. Your job is to protect capital and execute your plan. Money becomes a natural byproduct of discipline. If a setup does not form today, the professional simply closes the platform and walks away with zero loss. Take a deep breath and release all your past frustration, anger, and regret. Every blown account, every stop loss, every painful night was not wasted. It was the fee you paid for this clarity. You were not failing because the market was against you. You were failing because you were using the wrong map. Now you understand how smart money builds traps, hunts liquidity, and leaves footprints before major moves. From today onward, you must sit calmly, wait for the crowd to get trapped, and enter with institutions. Social media noise, indicator obsession, and emotional trading must end. Focus on liquidity, patience, and structure. Enter only when smart money shows its hand. My goal is not just to teach you a strategy. My goal is to reshape your entire mindset into a professional trader who respects risk, loves discipline, and grows stronger with every cycle. If these words touched you, share your trading story and thoughts in the comments. Take care of yourself, protect your capital, and protect your mind. May your journey always be guided and blessed. Goodbye.